Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'm probably going to share a view that is a little controversial. I don't think it will necessarily be a widely held view, but it's my view that the Melbourne property market will deliver the highest dollar value gains over the next 10 years. It might also deliver the highest percentage gains, of course, but I'm leaving in the back of my mind that Perth potentially might, on a percentage basis, slightly beat Melbourne, but certainly on a dollar value basis, because the starting points are different in terms of median house prices. The dollar value gain in Melbourne will be substantial. Over the next 10 years, I'm thinking that the median house price will at least double, and if it does that, that could be $900 to $1 million in terms of capital growth in that median house price over the next 10-year period. Now, before I get started though, I want to remind you of a couple of predictions that I've made over the past few years, not to pat myself on the back, but really just to illustrate a fundamental principle that returns eventually revert to the mean. So in November 18, I hosted an investment briefing in our office where I presented what I thought was a compelling thesis on why the Brisbane property market was poised for significant growth. And really the 10 years previous to 2018, the Brisbane property market was kind of on the nose. It hadn't produced much in the way of capital growth. So since calendar year 2019 through to 2023, the Brisbane property market has grown at a compounding annual rate of 9.96%. So over that sort of 5-year period, let's call it 10%. So the median house price in Brisbane is 60% higher than what it was at the beginning of 2019. So I guess that investment briefing, or the timing of that investment briefing, was bang on, which is not to say you can pick exactly when a market's going to turn, but in hindsight, that was more really luck than anything else. I wonder of the 20 to 30 people I think that attended that seminar or that briefing, I wonder how many actually invested in Brisbane, although, a lot of our clients, as a result of our advice, did, and they've done incredibly well. And you might recall in August last year, August 2023, I recorded a podcast episode where I shared my thesis around the Perth property market, suggesting that it's kind of on the cusp of a growth cycle. And again, almost to the month, the prediction has turned out to be pretty good based on CoreLogic's daily pricing. The last 12 months, the median house price in Perth has jumped 20%. Again, I don't share these predictions or these historic predictions as a way of patting myself on the back or, high-fiving myself. But again, I'm just sharing the same methodology that I used, an approach that I used for those predictions I'm using today, really for what I'm going to talk about with respect to Melbourne. And what I should really make absolutely clear is that I don't anticipate in the short term the Melbourne market will do very well. In fact, I don't think it's going to drop, but I just don't think it's going to perform as strongly as other markets. And I think that will persist for a little bit of time, but it will turn. And when it turns, it'll turn quickly and you won't really be able to predict when it's going to turn. So if I'm a long-term investor, I don't really care when it's going to turn. I really care about my 10-year plus returns rather than what will happen over the next 2 or 3 years, noting that it's impossible to predict. So let's talk about Melbourne and why it is on the nose, of course. From a property investment perspective, of course, Melbourne otherwise has some fantastic attributes from a livability perspective, but of course I'm completely biased. So in both 2015 and 2021, the government introduced much stricter laws regards to tenancy regulations and safeguarding tenants and looking after tenants, particularly protecting them from unfair landlords. And I don't think anyone on this podcast is probably in that category, but of course there are some landlords out there that aren't treating tenants fairly and they do need to be protected. Unfortunately, like all laws, they accommodate the lowest common denominator in any particular industry and we all get dragged along with it. And so it's a fact that they've increased compliance costs, increased maintenance costs, things like alarm checking, gas checking, all those sorts of things. All those things are important. We all want our tenants to be safe in our investment investment properties. But the reality is they have increased the cost to run an investment property. And then also the amount of control, and this is the big one, the amount of control investors have over retaining tenants if they've got problematic tenants in there. Can you protect the value of your asset by evicting tenants that aren't taking care of that asset? And, with some of these laws, your control over that is reduced, and I think that scares investors. So the tenancy laws are one factor. The next factor is going to be, of course, the obvious one, taxes, including land taxes and so forth. But there's been a host of new taxes. Of course, we've had most recently what they like to call the COVID-19 debt temporary land tax surcharge. It's a bit of a mouthful, that one, which is in place for a number of years. So it's temporary. Put that in inverted commas. I wouldn't expect that to disappear at any time. I mean, I don't think governments reduce taxes, do they? Windfall gains tax, absentee owner surcharge, vacant residential land tax. The list goes on. And I cite a report from the Parliamentary Budget Office that suggests that Victoria now imposes the highest property taxes across anywhere in Australia. So that's obviously contributing to the negative sentiment. And then, of course, there's a lot of concern around Victoria's surging debt, which is estimated at around $126 billion at the moment. But rating agency S&P thinks that could double by 2027. And of course, there's going to be a huge fiscal strain on the state, and we're already kind of seeing it regarding arguments between the federal and state government around funding of hospitals, arguments between local council and state governments about maintaining roads and those sorts of things. That noise is only going to get louder, of course. And now there's even talk about a federal bailout of Victoria and possibly also Canberra. So, that's probably likely. It's probably likely on the cards. Otherwise Victoria will have to sell assets, I think, to get their debt under control, because they're not going to get it under control with taxes. If they raise taxes enough to have an impact on the debt, they'll realise it's going to kill Victoria. So they're not going to do that. Anyway, it's on the nose, and, to try and pick the bottom of the market, it's really difficult. But typically the bottom of the market is when the noise is very acute. The negativity around a particular asset or thesis is very acute. And I think we're kind of at that point now. I think everyone is negative about Victoria and about all these factors. And then I think you've then got to think about, okay, that's great. There's all the negative aspects, but to what extent are these negatives already factored into current prices, right? Because we might think, Victoria's no good, but Victoria's cheap relative to other states, which I'll talk about in a second. So my argument would be these negative factors are already factored into current property prices. Now, as I've pointed out in this podcast previously, Melbourne's geography is a lot different to Sydney. Sydney is bound by water and national parks, whereas Melbourne's much more sprawling than that. It can spread out to a sort of accommodate increased population. And remember that Melbourne's population is predicted to exceed Sydney by 2036. So our population is growing. It's growing fast. The economy will hopefully benefit from that as well, despite the government's mismanagement. And one of the side effects, however, of a sprawling capital city is that sometimes investors start to think that new build areas represent almost a similar kind of investment opportunity than blue chip areas. And in the short term, that can kind of be the case. When you get a new build area that's kind of gets built out, attracts more amenities such as, you need a doctor's surgery in there, you need a school, you need a supermarket, a shopping centre, maybe some restaurants and cafes. As that new build area gets built out and attracts those amenities, of course, property prices increase. And that's why developers release land in stages, obviously, because, the fifth stage is going to cost a hell of a lot more than the first stage. And sometimes that can misrepresent growth rates, when people look at property and property growth. But one thing is true is that Victoria, and I think Australia generally, cannot build infrastructure fast enough and cost effectively enough. Now, Victoria's gone out of their way to prove that point, but it is true. And so congestion is going to be an issue. It's an issue today. It's going to become a growing issue. And the disparity between living close to the CBD, so, in a sort of 10, 15K radius of the CBD versus 35Ks out, the disparity is going to be huge. And we're kind of already seeing it today where people that are living much further out where housing is more affordable have much, much longer travel travel times. And that means that they need to decide, do they then get a job closer to home, which may actually pay less, but then reduce travel time and then give themselves more time at home to look after kids and so forth. And also, not only will it pay less, but there's less opportunities, less career opportunities and so forth. Or do they suck up the travel time and prioritize career opportunities and income earning capacity, but as a result need to spend more time on public transport, which of course is unreliable. This is becoming a bigger problem. And so if you look over the next 10 plus years, certainly 10 years from now, it's going to be an even bigger problem. So I guess what I'm saying is don't get too distracted by these outer suburbs, these growing suburbs that might on the face of it look like they're providing good capital growth. The reality is, as property investors, we hope to own these properties for many decades. And if we do, we've got to think about how are those assets going to behave, 10, 20 years from now. And I think blue chip properties are actually relatively cheap. If you've got to pay $1 million for a relatively large house, but it's, 35, 40 Ks away from the CBD, whereas you can buy a relatively much smaller house, but in a great blue chip suburb, and it's going to cost you $2 million. To me, it should cost you more than $2 million to live in that location, given the lack of supply and the amount of demand that's coming our way from a population growth perspective. Now let's talk about relative values, because I've drawn a chart that compares Melbourne's median house price to other capital cities since 1980, and it's pretty compelling from an illustrative perspective. Of course, you'll find that on the blog on the website, and of course the links in the show notes as always. And it shows that Melbourne is relatively cheap compared to historic averages to Sydney, Adelaide, Brisbane, in fact all capital cities except Perth. And maybe that's because Perth is somewhat undervalued at the moment. And I think Perth and Melbourne are really the two most, from a pricing perspective, the most attractively priced capital cities. And so to put some numbers around it, on average, the Melbourne median house price is 74% of what Sydney's median house price is. Today, it's 57%. So substantially below. Brisbane, normally Melbourne's median house price is 1.3 times. Now it's 1.1, and it'll soon, potentially, towards the end of the year, it's expected it's going to be on parity, and maybe eventually Brisbane will start surpassing Melbourne. So, there's a 30% kind of differential there. So I think relative to other capital cities, it's very clear that Melbourne has A, underperformed, and B, looks to represent really good value, I should say, compared to those markets. And I think the best market to compare against is Sydney, just because it's very similar in terms of population size. And so it's going to have similar employment opportunities, similar congestion issues, all those sorts of things. And as I said, Melbourne's median price, at least at the end of December 2023, was 57%. It hasn't been that low since 1981 when it was 56%. So it's almost at an all-time low relative to Sydney. And Sydney has underperformed other capital city markets as well. So, I think it really does stand out to me from a mean reversion perspective. Now, I've shared a chart in this podcast many times that demonstrates that all housing markets go through two cycles. There's a flat cycle followed by a growth cycle, followed by a flat cycle, followed by a growth cycle, and so on and so forth. And for you to enjoy decent returns, you've got to enjoy just as many flat cycles as you do growth cycles, which means that if you buy just before a flat cycle, well, you've got to keep that property for a much longer period of time to enjoy long-term average returns, because you've got a flat cycle, then you'll get a growth cycle, and so you might have to hold that property for 15, 20 years in order to get that average return. Whereas if you buy just before a growth cycle, then it's entirely possible, in fact probable, that your returns will be above average for the first 10 years. And so in an episode more recently, I talked about, being really conscious of where you're buying, which cycle you're buying into. And if you're buying just after a growth cycle or just towards the end of a growth cycle, the chances are that your 10-year future returns are probably going to be below average. Not necessarily a great thing to do. You're better to buy into a market that's been in the doldrums, like Melbourne, for example, since 2017, and your likelihood of better future returns years is much higher. Anyway, if you haven't seen that chart, check it out. It's a really popular one that I've posted many times, although I've, of course, updated the most recent data through to the end of last calendar year. But it's a really good chart that really shows you how different markets have performed and where they all are in the cycle. Now, you may recall that in March this year, I recorded a couple of episodes around what to do with an underperforming apartment, and most of that commentary was aimed at Melbourne, although the methodology could be applied to lots of different markets. But I think it's worth calling out the investment grade apartment market in Melbourne that has been in the doldrums for more than 10 years. Well, thesis applies to that as well. So, I mean, if median house prices are going to probably double over the next 10 years, then certainly apartments are going to benefit from that appreciation as well and get dragged along the ride. So, I think this analysis, adds further weight to that analysis that I did back in March. Now, I thought I'd close out the conversation by asking, what will you think in 2034? So really 10 years from now, will you look back at property prices in 2024 and even 2025 and go, wow, they were cheap. I should have bought a couple of properties back then. That's a really good question to ask yourself, because it really invites you to really focus on that long-term outcome. And while I think sentiment could get worse in Melbourne, prices could fall a little bit, although, there's not a lot of discretionary vendors out there. So I think there won't be a lot of forced selling. I think people will be reluctant to sell, or they've got a discretion around timing of selling in Melbourne. So I think supply will meet demand, which means that prices will be kind of underpinned by that. So I don't think the price is going to come off very much, but it's entirely possible that Melbourne's going to continue to be quite subdued over the next 1, 2, or even 3 years. Now, I don't really know when it's going to change, but my feeling is, as I said, we're at the peak of the negativity, or close to the peak of the negativity at the moment, and that tends to be kind of the right time to jump in. The biggest challenge in Melbourne is going to be finding the right property. As I said, because stock levels aren't too bad, but they're relatively low but aren't too bad, it's really the type of stock that's available for sale, and really we don't find that there's a lot of great quality stock. And buyers agents that we work with might be looking for 6+ months until they find the right property to buy, which is fine. You can have the patience in order to find the right asset, that you don't need to rush into the market. And also, as I said, I don't think the market's going to take off tomorrow. So, it's not like we're missing the boat or anything like that. But that's really your main challenge, I think, in terms of investing in Melbourne at the moment. Okay, so there you go. I look forward to recording an updated episode 10 years from now to look back to see what subsequent returns were from that prediction, which I'm happy to do, even if I'm incorrect, of course, because that would be a good topic of, what went wrong. But also I'd like to mention that if you do spend any time on YouTube, I've got a link in the show notes to our YouTube channel. I'm posting videos seemingly every couple of days now on different topics. So if you're interested in that, and there's also a link where you can ask me a question, I'll respond to it. But until next week, thanks very much for listening, and bye for now.